The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, live here from courtside, croquet's courtside here at the sunny Boca Raton Resort and Club here in Boca Raton, Florida. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network, and I'm joined today, unfortunately not by Don. I know he was very excited to join me today down here courtside. We have some history here at the Boca Croquet Courts, but thankfully we have a more than able stand-in, Bob Krause, the CEO of Volex. Bob, welcome back to the show.
Hey, thanks, Mark. Really happy to be here. What a lovely place for a conference, and we've had great weather and meeting some terrific people, really from all over the world. They're executives and from the FCM community, the exchanges, the investment banks, and they all converge here to meet and greet and really discuss issues about the industry.
Yes. For our listeners who don't know, who aren't at these conferences on a regular basis like you and I, it has been quite the conference-heavy week down here in Florida for the derivatives business. It actually kicked off, and I was lucky enough to swing by earlier this week at the CBOE holds a conference every year called the Risk Management Conference, which, as you might expect, discusses various aspects of risk management and volatility trading and things like that. And it was a fantastic conference on a number of levels. The content itself was truly spectacular. Actually, they delved into a lot of the topics we discuss on this show. Straight up index puts versus a volatility hedge, and which performs better, and different ways to structure those types of trades, dispersion type trading, volatility cycles, when the spike occurs. It was actually interesting to see the various banks give each of their own takes on the volatility cycle. And here's Merrill's take, and here's Goldman's take, and which of these is correct from a pure volatility perspective. So there was a lot of very interesting content. But I think what made it doubly interesting from my perspective, and I'm sure yours as well, Bob, if you were there, was that there were quite a few people there who were fans of Vol Views. I would going to lunch, going to meetings, going into panels. People were coming out to me all the time. Various strategy research directors, traders, quants, what have you, coming up, telling me their favorite episodes, telling me what their favorite parts were, what their favorite discussion topics were. People were very fluent in the show. So I just want to start off and say, tip my hat to all of the listeners out there who are listening to the show right now, who came up and gave us all those great well wishes over at RMC. That was greatly appreciated. I think we also found a great font of new guests as well. There were quite a few people there, I think, who we could bring on the show who will be have very interesting perspectives, let's just say, on the world of vol and volatility. So it was certainly a fantastic conference from a number of perspectives. And then, of course, moving on to where we are today, which is, of course, the Futures Industry Association annual expo here in Boca Raton. And this is definitely a different type of show, not as much on the trading end, more on the institutional exchange, execution type end, I suppose you could say. And a perfect show for guys like you, Bob, who are coming out here with some interesting new products and looking to show the world your wares, so to speak. So has it been a fruitful show for you?
Oh, absolutely. We're in a good spot. It's taken 3 years to kind of move to the right spot here, but that's everything, as they say in real estate, location, and we're like right on the corner, and everybody's stopping by, and those that have not heard of Volex are interested in what we do, so we're giving them a mini seminar, about 30 times a day, and
listeners, you can't see right now, but Bob actually has this fantastic little mini projector running that he's been using all throughout the show. And that's kind of his little cheat sheet for today. But it's a fantastic little device that he's been using to educate the world about Vol and Volex.
Right, and I don't want to miss anything and give our misinform our listeners. So you're going to get the same kind of discussion as we give everybody here at the show. And then just meeting new people, new guys. There was a quant trader from an investment bank in Hong Kong who we had lunch with and is filling us in on the best method of how we could roll out realized volatility in Asia. Because it's a very different place with not too many listed options, much more warrants, and
that's interesting. That creates a totally different dynamic for the product.
Right, and all of the exchanges are sort of closed. It's the Korean exchange is really only Korea, and Singapore exchange is probably the only one that sort of broke that mold a little bit by offering contracts from Tokyo and Taiwan and India and things like that. So, but for the most part, it's kind of a closed society. Our Europe and America is a little bit more open, where we list some European products, ADRs and futures that trade all over. Same thing with Europe. But in Asia, it's just a little different animal. So we were talking to him about the best way to get out there in the future.
Well, that's fascinating. Something you don't even think about probably until you get down here to Boca. And this is definitely, for those of you who haven't been, definitely much more of a meet and greet type of show than a content. There is content, obviously, here too in panels, but you definitely come down here to meet different people from across the world. It really is you have the European contingent, you have the Asian contingent, you have South American. It really is a melting pot, to use a vastly overused cliche,
right.
from the derivatives world. All right, so listeners, as you might have imagined, Bob and I have both been very, very busy gallivanting around the world this week. So what we're going to do, actually, this episode is a little bit of a departure. Maybe this is more of our conference format. I think we did this down at OIC last year, too. You and I have this the conference show that we like to do, where we'll kind of dive into some particular topics in a little bit more depth and focus on that one segment for the Volatility Viewpoint. So without further ado, let's dive right into our Vol Viewpoint.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome back to the Volatility Viewpoint live here from a very active croquet court at the Boca Raton Resort and Club. We are watching a heavy match get underway as we speak, but that's why I'm talking in my hushed golf tones. But I'm doing my best golf announcer impersonation. But I think Bob and I were discussing before the show what an interesting topic would be for this particular show. And we harkened back a little bit to what Don and I discussed on a recent show as well. I think because of the mention we've done on the show in the past about the upcoming Nasdaq products and all of their various forms and flavors and varieties, we were starting to receive a lot of feedback. I'm sure you are here at this show as well, just in person, about the mechanics of these and what exactly, because we are talking about a variety of different products and different interesting things. And some people who are coming to this for the first time who didn't trade the euro, who maybe haven't heard the show earlier, are really starting to bombard us with various mechanical questions about how these work, the underlyings, and the mechanics of how they actually perform. We touched on it a wee bit, I think it was last week, with Don giving some strategies, which is kind of the next step for these products. Once you understand them, how you can implement them. But I think Bob and I agreed that given the influx of new listeners we have and people coming to learn about the NASDAQ, it made sense to, instead of scattering tidbits throughout the show, every episode we do a little bit of a mechanical update or some sort of breakdown, and having listeners have to go listen to 15 different shows to get all the information, we instead compile it down into one overview episode. So if you're a new listener, this is perfect and ideal for you. If you've been listening to the show for a while, I think there will still be some interesting tidbits we're going to get into about some of the mechanics of these contracts and how that will apply going forward to the much looked forward to Nasdaq products. So I think, Bob, let's just take it from there, and maybe let's start at the root of it, the genesis of it, as it were, perhaps with the very idea. Where did this idea percolate up from in terms of the realized vol contract and how you got to actually where we are today with this formula and with these tradable products?
Okay, great.
In 5 words or less.
Yeah, okay. Okay, so it really started probably back in 1993 when the CBOE wanted to trade volatility. Now, I don't know exactly what happened or how it worked, but I'm going to speculate a little bit here that essentially the CBOE wanted to trade volatility, and they weren't sure of the best way to do that, so they contacted Robert Whaley, and they said, essentially go design something. So, like I said, I don't know the exact mandate or exactly what the CBOE told Robert Whaley, but he was looking at the situation, and here's what I think happened, that he's sitting there looking at the two flavors of volatility. There's, at the time, historical. Nobody really called it realized volatility at the time. And so there's historical volatility and implied. And as soon as you frame it as historical or implied, well, that kind of clouds your thinking immediately because, well, you can't trade on historical. That happened already. So, what are we doing here?
That's kind of how I grew up in it, so to speak, was always referring to it as historical. I think, yeah, you're right. Realize is a much more modern incarnation of that term. And I think much more practical, too, because that actually implies you're right, actually use this for something practical as opposed to some nice graph you can put on your wall, and that's kind of about it.
Right. And so, with that thinking, then he's like, well, the answer has to be implied. And so, and then that just spawned this whole developmental effort. Well, how do you trade on implied? Well, you can't just use one strike of one call, let's say. You got to at least average it with the put. And, well, maybe we should use more than 2. Maybe we should use 4. And then, what should we have it on? And how long should the time period be? So then it came into this whole interpolation thing. So it just spawned, one thing after another to actually, how do you create an index on implied volatility? And it actually turned into what I thought was a very complex, somewhat convoluted, maybe that was the best way, but, it was still a very complex kind of way of thinking about it. And when this was announced that we're going to list the VIX index, I immediately thought, well, that's not a great, I can't believe that they're ever going to trade on that. And sure enough, for many years after that, they didn't. I mean, they tried. I believe the CBOE talked many times internally. I think they even went to the CFTC. It could never really get going. And around 2000 was about 7 years later was when I was at one of these conferences. I don't remember if it was the FIA show, but something similar. And we got on the subject I was talking with the guy next to me, and he happened to be an IP attorney. And that was right around the time when all of these process patents were getting approved, filed and approved, and how you could process a patent. I mean, sort of the epitome of that was like one-click buying from,
It's been a dubious development, I think, in a lot of respects, given some of the processes, quote-unquote, that we've seen patented.
Right. So, but he said, this is a process, and so I tried to patent the methodology on trading realized volatility, and which was very close to the way they trade vol swaps in the over-the-counter market. So that's kind of how it worked. And our patent is fairly broad. Essentially, it's on realized volatility, not implied. So the CBOE and the VIX is outside of that. And it's on volatility and not variance. We tried to patent variance, but the patent office wanted us to narrow it down a little bit. So I was happy to give away variants because I didn't think that would be a viable product.
Yeah, that'd be a beast of a product too.
Yeah.
Given some of the strikes and the quotes.
Well, and the margin. I mean, the CBOE actually tried to launch a realized variance product, and it didn't work. One of the reasons, I don't know for sure exactly why it didn't, but one of them was just the margin. If you look on the CBOE's website, the margin for this single contract could go up to $250,000.
Yeah, it's enormous.
I mean, who has the ability to trade such an instrument? Well, I can name about 9 guys,
and
it starts with UBS, Goldman Sachs, Morgan Stanley, Credit Suisse, Barclays, and the other 4 or 5 that I happen to miss. And those guys don't need a listed variance product to trade among themselves. So, I thought I didn't think it was a good idea from the beginning. It turned out that it wasn't such a good listed product, at least so far. Maybe they could revive it in some other incarnation. But what I really wanted to concentrate on and what I really believe on is that people need a way to manage risk directly. We've always been able to manage risk, but we've never been able to trade risk. And at least the price risk is what we're talking about, not necessarily default risk and all those kinds of risks. But price risk, we were never able to trade directly.
But let's hit on that for a little bit then, what you're talking about with the various risks, because I know, like I said, a lot of our listeners are coming to this either interested in the Nasdaq, so they want to know more, or they're kind of just coming to this for the first time. They discovered the show and they want to know, I think, down to the nitty gritty of really kind of how these work. So maybe let's dive into that a little bit. Let's keep it. If we can probably fill the whole show with exactly how the mechanics of it. So we'll keep it maybe a 5,000 as opposed to a 10,000 foot perspective. A little bit deeper than that on some of the methodology of how we calculate that. And then for listeners who've heard this before, we're getting into some of the other vagaries of NASDAQ shortly thereafter. So that'll be your tease to stay tuned. But Bob, let's start there. How do you calculate this realized vol, and get into the mechanics a little bit of the actual vol contract?
Right.
The vol contract. Again, we're recording live here, so all sorts of fun noises going on in the background. Go ahead, Bob.
Yes. Many people understand realized volatility and roughly how it's calculated, but there are all kinds of subtle nuances that, exactly when are you going to expire, exactly what days are covered, and exactly what's going to go on when you switch from NASDAQ to something else. You trade gold, what's going to change? All of those questions, even when you understand realized volatility or what a vol contract is, there are still other issues. So we want to dive into that. So first of all, we signed an agreement about a month ago with the NASDAQ index guys, and we agreed to launch realized volatility instruments on the Nasdaq 100. And that would amount to launching futures versions, okay, so what we call vol contracts, options on that, so vol options. We may even go into the over-the-counter market where they have these things called SEFs, or swap execution facilities, where they standardize a contract and then centrally clear them. And we call
big topic of discussion down at this show, by the way.
Yes, absolutely.
SEF, very, very controversial subject.
Right, and that's more or less born out of the regulatory environment where they're trying to move over-the-counter instruments from this opaque kind of OTC market to an exchange environment. And one of their suggestions, I guess, is this SEF, or swap execution facility. So we want to try and hit that market as well. There are different traders in different markets. The idea is the same. The formula is the same, but we're trying to bring in users from the futures market and from the options market and the over-the-counter market and even the securities market. So how are we doing the securities? We're trying to create vol ETPs. ETP stands for Exchange Traded Product, and it's kind of the generic name for ETFs and ETNs. ETFs are Exchange Traded Funds. ETNs are Exchange Traded Notes. Exchange Traded Notes work like essentially like a listed swap. The counterparty on the other side is an issuer like, say, Barclays or Credit Suisse or some institution, and you buy these swaps that are now called ETNs. And there is credit risk to those products, but they can essentially structure it any way they want. And in our case, we would try to structure it as realized volatility. The problem when you get into the security space, not only are you dealing with the SEC, but there are design elements that are very difficult to kind of overcome. And we'll talk about that when we get there. Let's talk about the formula first.
Yes.
Okay? So the formula is kind of like a standard deviation formula that you can find in the back of any high school statistics book. But one of the features of a standard deviation formula is you're trying to find the deviation about some number. So if you were trying to do a poll, an exit poll for a candidate or something, or let's say we're trying to figure out the height of kids in 5th grade or something like that, right? The first thing you'd want to know is, well, what's the average height of the kids in 5th grade? So you'll collect all the height data from all the kids, and then you know that not every kid is going to be exactly that average. So then you want to figure out, well, what's the dispersion about that average? Okay, and that's where the standard deviation formula comes in. And so we're actually calculating the volatility, the variance, the distribution, what's another term? The dispersion of height around that average. Well, in the markets, when you calculate an average, what you're calculating is the average return or the trend, essentially. So if you calculate it over a month and you say, well, what's the average return? Well, that month, maybe the average return was up 1% every day. We had a really strong trending market, and it was up 20% for the month. Okay, well, what if we were up exactly 1% every day for the 20 days or so of the month? Then you know what? Its volatility is zero, because you're taking out the trend and you're figuring out the dispersion about the trend.
Yes.
Well, somebody looking at that saying, well, the market's up 20% and the volatility is zero. What the hell's going on with your calculation? It just doesn't make any sense, right?
Not intuitive to the masses, to say the least.
Absolutely. And it also doesn't work with hedging your options book when the market moves 20% and the volatility ends up being zero, because it's not. And also, when you look at the over-the-counter market, they don't calculate it that way. So what they do is actually set that mean to zero.
Don's favorite, removing the mean. Don's favorite term.
Right.
One of them, next to sell to you, of course.
So we remove the mean, and what that does, not only does it make it better for option hedgers, it also makes the formula much simpler. And so that's all, that's half of what we're about. Make it as simple as possible. Obviously, give you realized volatility, but make it as simple as possible. So one of the things that we try to do is try to keep all the terms, try to keep the formula as simple as possible. And here was one wonderful tweak that you could change the standard deviation formula and set the mean to zero, make the formula simple. And now all we're really doing is looking at the returns each day. So, the market was up 1% today, and then it was down 2% tomorrow, and then it was up 3% the next day. And we take all those returns over a period, and then we calculate the realized volatility. We're always annualizing with 252. We multiply the result by 100 so that 25% becomes 25, and we trade it in a kind of dollars and cents version, 25.25 or something like that. And so that's the formula is fairly easy. It's on our website. You can do it on the back of an envelope, and you're really just looking at the absolute changes every day. So instead of, if we set the mean to zero, instead of calculating the dispersion about the trend or about the mean, we actually calculate the dispersion about zero. And what does that give you? That gives you movement regardless of direction.
Yes,
So,
it's that mean is the. It seems like such a simple concept when you think about it intuitively, but yet it makes all the difference there. We've touched on it in the past, but you're right. That 1% theoretical, that 1% move a day would be zero vol, and I don't think many people would really want to trade that product.
Absolutely.
Without that mean removed. So we hit on the methodology. I think one of the most common questions I'm receiving, whether it's via email or talking to people at these various shows, I think a lot of people, because, and actually, in fact, we discussed it on the last show, and Don wasn't sure, so I kind of jumped in your stead to discuss this, but now maybe we want to hear it from the horse's mouth instead, is a lot of people are still confused. They think NASDAQ, they think, well, okay, it's going to be a proprietary NASDAQ product, and that's where you have to go, either OMX or the Philly or one of these other,
right.
One of their exchanges in their stable. So why don't you clarify for us exactly the listing, what you're thinking of in terms of listing, and will it be available across the plethora of exchanges that we see here at this conference?
That's right. So what we want to do, our agreement with NASDAQ is really to develop the products, and that means we are free to develop the products how we see fit. We just share in the revenue, and really that's pretty much the extent of our agreement. It's on the the Nasdaq 100. And it's to develop the products. And what are the products? Well, we have vol contracts, which are futures-based volatility products. We have vol swaps, which are the OTC based products. We have vol options, which are the options, and then vol ETPs, ETFs, ETNs. And those are the securities-based products. So we're trying to hit the market from all directions and develop it from all sides. And that would necessitate going to other exchanges because NASDAQ just doesn't have the ability to do it from all sides. So are we locked into doing it from their side when they can, kind of thing? Absolutely not. We can go anywhere we want. So, in fact, the NASDAQ futures trade at the CME. The NASDAQ options trade at several exchanges. NDX options trade at several exchanges. And then there's the Qs, the QQQ ETF. It's like the spider. It's yes. I forget what. I guess just an exchange traded fund. And then there are options on those products that trade in several places as well. So
that's something else we see a lot of interest in, especially these days. There's been a lot of discussion about the ETPs that have sprung up around the VIX and all the interest in those, and whether how much of that is going back into the actual product and driving that. But obviously, it's still very early days. You haven't even listed the product yet, so this is more of a theoretical possibility. But let's talk a little bit about what your plans are for the ETP universe around the vol contracts. Are you thinking of looking to have notes and all the other various, I guess you can call it ecosystem around the vol? Is that the plan anyway going forward, to have another ecosystem spring up around it of these various products that are linked back to the main vol contract?
Well, yeah, that we do want to do that. But before I explain ETNs and ETFs with you, Mark, and our audience, I'd like to talk about the various products first, because ETNs are a special animal in realized vol. We can't launch them like we can with VIX. It's a very different animal and a difficult thing to actually get accomplished. I mean, it sounds easy. Okay, so we're just going to launch an ETN on realized vol. It's not that easy. And let me get to it, but let me first talk about the futures. So vol contracts will probably be the first one to launch. And like I said, we're not locked into a particular exchange. So we're talking to all the exchanges. We're talking to CME and NYSE Life. We went to the CBOE and talked to, about the listing on the CFE for the futures. Let's just stick with futures right now. And so everybody's interested in talking to us about it. There are good points and bad points with any exchange. And we're trying to work through all those issues right at the moment. We haven't signed on yet, but it'll probably be at a major exchange. You'll be able to trade VolX, Nasdaq 100, vol contract futures somewhere that you're already connected to. So that shouldn't be an issue. The actual terms of those contracts, it'll be $1,000 multiplier. It'll have a nickel tick size, and it settles to cash. It'll be a cash-settled instrument. So that's it's exactly the same. I was going to say very similar. It's exactly the same as VIX futures. VIX futures are $1,000 multiplier, nickel tick size, and cash settled. So it will be as close as you can to a VIX futures to spread them or trade against one another if you wanted to. Next are the options. And for options,
which I'm sure the bulk of our listeners are very, very interested in, even more so than the futures.
Yeah. Well, yes, we've gotten a great number of participants interested in the options on volatility. And those options could be singly listed with an exchange, let's say CBOE or Philadelphia. Philadelphia is keen on doing it. The Nasdaq owns Philadelphia, so that'd be a natural fit. But we don't have to go there. We're going to see how much they charge us, to be frank about that. But, they're interested. CBOE is interested. We talked to Amex and ARCA and ISE and really all the major exchanges about listing the product. Everybody's interested in doing that. We may even multi-list and say, have at it, guys. Everybody can list them. And, as you know, many options and index options are multi-listed.
Yes,
now,
that's
so,
definitely
right.
for the end user. I know they love that because then it tends to tighten spreads, and the old rising tide lifts all boats kind of analogy. We spread it out on more exchanges, more people come in and play, and it ends up feeding back amongst itself and just driving more volume. But let's hit on the options then for a second, because I know, like I said, a lot of our listeners are very intrigued by that. And I know, given your previous stances on implied versus realized, do you find it ironic to be now contemplating listing an implied product on your existing realized contract? Does the irony strike you at all with the options, or is that just par for the course, I suppose?
Well, what do you mean by an implied product?
The options would have a vol that's implied by the...
Oh, I see. Right. Well, there'd be an implied volatility to the option.
It's kind of inescapable at that point, yeah.
Right. There'd be an implied volatility of the options on realized volatility.
It was my attempt at a joke, Bob. It went right over your head, so
sorry.
You're killing me here. But so I guess the answer is it doesn't keep you up at night to be listing an implied vol product after all your denigrating of implied volatility.
Yeah, sorry about that. I just saw a great shot on the croquet court, and so
you're fascinated by the croquet game going on behind us. But we hit on the actually you hit on the futures, you hit on the options. I know you're also contemplating the vol shares too. Do you want to get into that a little bit, or is that kind of?
Sure. Let me just say that it's a proprietary instrument that it's new. Okay, it's never been done before. We've tried to file for a patent on that. Right now, it's patent pending. Whether we get that or not, I'm not sure. That'll who knows how long the patent office will take. But what we need to do with that is to get regulatory approval. So before I really get into it and kind of explain it all, it's
down the road a bit.
Yeah, it's down the road because we don't have regulatory approval. We don't have authorization. It isn't kind of like, okay, we're all set to go. We just have to figure out how to launch it. So let's just save that for another day when we actually have something, because right now it's just vaporware. It's just an idea. So we need to develop it a little bit more. But that doesn't mean that we're locked out of the securities space. And so now there are currently, ETFs and ETNs. And to get back to your question, how are we going to tackle that? Well, let's suppose we wanted to create a realized volatility ETF. Well, how do you do that? Well, you would have to invest in it's a fund, right? An exchange-traded fund is a fund. And instead of that company making widgets or whatever they do, this company invests in stuff. And what would they invest in? Well, they'd have to invest in volatility somehow. Well, there is no spot volatility, so they'd have to buy vol futures or vol contracts, right? So in order to get the ETF running, we would need to have vol contracts running first. So it's a two-step process to do an ETF. So that's one kind of hurdle that we would need to do. So that ETF then would invest in vol contracts. But another problem is, well, how do you give somebody realized? The only way we can give you realized is to expire to that formula. We can only give you pure realized volatility if we actually expire the contract. So now we're talking about a fund that expires. Well, that's not going to work.
Yeah, that doesn't play into the fund model.
You know why? Because, I mean, it just costs a ton of money to market and create one. And then, all the assets is how a trustee and how a management company makes its money. At the end of the month or, the third Friday or whatever, it expires and it's all done. And now what do you do? Well, you could create another fund, but that's another expense. And it's not as quick or easy as, just listing another futures contract.
I suppose you couldn't really just roll it and you couldn't do some, I guess you suppose you could do some sort of arcane settlement process like we've seen before, and maybe that could be the way to work it out. But that, as we know, comes with its own issues.
Right. So we then looked at the ETN market. Now, ETNs are exchange-traded notes, very similar to a swap, or in our case, a volatility swap. Again, though, we're talking about an instrument that expires. We still need it to expire to give you realized volatility. So now that's not as costly as a fund, so maybe we could do that. But we'd have to get it through regulators because nobody's ever created one before. Not only is it on realized volatility, which is a new thing, but then we're talking about an ETN that expires, which is a new thing. Okay, so we got the regulators to deal with. It still costs money to create an ETN, so whether that cost is worth it or not, I don't know. I'm sure it's less than a fund, but it's still a cost. And then to, again, expire every month, that might be a cost that's just too large. But let's suppose that we exceed those hurdles. We fix those problems, or we say it's worth it, and we go through the regulatory issues, and we go through the expense, and we create these expiring ETNs. I don't know if the world is ready for an expiring stock, okay? It's never been done before. Yes, options expire, but, you have to go through the whole characteristics and risks disclosure. You have to, open an options account. And, yes, there are futures, there are options that expire, but stocks don't. At least they haven't. And if we create a realized volatility ETN as a stock, it has to expire. And then I'm wondering just about the psychological
that's
aspect.
An educational and fundamental hurdle to overcome before you even get to the product itself. And people have, you're right, people have a hard enough time with options expirations and futures expirations. You get the actual stock the actual stock expiration would, I think, blow a lot of minds. I'm sure some of the guys I met over at RMC would like it and be able to process it, but I think the vast majority of newcomers, particularly from the active retail space, would have some processing. You'd probably get a few phone calls, and I'd probably get a few emails, which I would have to then forward to you. So you'd be a busy fellow for quite a while.
How I bought this thing, and it isn't in my account anymore. What happened to it? It's an education process. It'd be a difficult thing. Now, maybe the world can, accept it right away, and that would be great. But what would we create if we did that? Essentially a micro or tiny little futures contract. So you could trade the futures, maybe, okay, it's a smaller size, but you can essentially do the same thing in the futures world. So if you're comfortable with a stock that expires, well, maybe you should just be comfortable with a futures that expires because it's really no different. But one thing we ran across, which I'd love to hear everybody's thoughts on this. So if you could write in and give us your thoughts on this. Right now, there's a rolling mechanism to the 40 or so volatility ETNs that are based on VIX. And this rolling mechanism generally is to roll 30 days before the futures expires. Okay?
Yeah, that was a consensus at the conference, actually, that 30-day point is, is the optimal point for rolling and avoiding all of the headaches you get into when you get into the front month and all of the, exponential decay and all the other things that kick in at that certain point and all the other issues.
Okay.
Yes, but go ahead.
Okay, so, so they're rolling 30 days before VIX futures expire. But what does VIX futures expire to? Well, just about the VIX index. Okay, I say just about because it's not exactly.
Yeah,
there's
an exact science.
Right, there's a special opening quote, and it's not really the VIX index, but So let's just, for purposes of this show, call it the VIX index. So everybody is trading futures, trying to forecast what expiration is, right? That's how futures works. If it's now April and we wanted to trade September corn and everybody thinks September corn is going to be $5 a bushel, but it's $10 a bushel now, it doesn't matter because September corn should be trading around $5 a bushel because we're talking about what the price will be at expiration in September in this case, right? So when you're trading VIX futures, you're trying to forecast, well, that's 30 days out. I'm trying to figure out, well, what is the VIX index 30 days from now? That's what I'm going to be trading now. That's what the futures price should reflect. So I'm trying to forecast the VIX index at expiration. But what is the VIX index, right? I mean, that's implied, and it's all based on like the next 30 days options and all that stuff. So in a way, it's like a forecast of a future forecast, right? Okay, so in my way of thinking, the VIX, the VXX and similar, the 40 or so VIX ETNs and ETFs that roll 30 days before the VIX futures expire is really 60 days before the answer. Okay, we're trying to take you to the end, give you the answer. What was the volatility? That's what we're expiring to. VIX is, well, what's the forecast of that volatility, right? And I know Don is going to argue with me, but just that's
what makes for a good show.
Humor me for a minute. And then futures is 30 days before that. So it's really 60 days before the answer. Now, if we take that same rolling methodology, roll it with ours 30 days before ours expires, we're actually rolling right around when the VIX is rolling.
With the roll.
Okay? And what do we give you? We essentially give you 30-day implied, a rolling implied volatility. Well, what is the VIX? It's a 30-day rolling implied volatility. So, ironically, even though we are giving you realized volatility, even though our contracts settle to realized volatility, and even though they created the whole VIX index and implied volatility, none of their products settle to the VIX index. You cannot trade the VIX index directly. With ours, well, you couldn't trade the VIX index directly either, but it should move very closely to the VIX index because of the relationship between VIX and ours, that the pricing of ours should be very similar to what the VIX index is. And so we actually could give you something probably closer to the VIX index, not the futures, but the VIX index with our products in an ETN or ETF form if we do this 30-day rolling kind of process that all these other ETNs use.
That might be because we have such a litany of great guests on this show, maybe that's a stock question we could hold in reserve for each of them. What's their opinion on the roll process and the best way to implement them? Because we do have quite the cross section of volatility views on this show, so it might be a good way to bring some of their expertise to bear on this point. I know that was indeed an interesting topic of conversation this past week at that conference, and rolls and roll risk and the roll down and the various costs associated with that and how that impacts the accuracy of the overall process was quite the active and lively topic of conversation. I think there's a lot of grist for the mill here, so to speak, in terms of looking at that roll and exactly where that process kicks out and the 60-day prognostication that you're essentially rolling on a regular basis and all the interesting mechanics that go therein. So let's continue our deep dive in here. I know we're running close to the end of our time here, but people do want to know even more about the mechanics. And one of the questions we hear a lot is the closing price issue. I mean, we get into that all the time on the show, the frame of reference of volatility, close to close, open to open, intraday, vol viewpoints. So people wanted to know, and perhaps you can address this, why the closing prices, Bob?
Yeah, well...
Why?
Why?
Pounding the table, listeners, you can't see it.
Why? You could argue that just closing prices is not accurate enough. Well, there could be something said for that. And in fact, there have been studies saying that if you use the high and the low, you're going to get a more accurate volatility value. If you use the high, low, and close, you get an even more accurate volatility value. If you use the open, high, low, and close, you get an even more accurate volatility value. But all of those accuracies come with lots of complexity. Okay, for instance, and I don't know if this is true anymore, but the CME, even while I was there, years ago, traded butter, and that product traded for 5 minutes on Friday, at 9 to 9:05. Okay, so
that's the best trading product. If you're from a market maker time perspective, that's the best product ever.
Well, okay, so now we want to create the volatility of butter, let's say. Well, how do you create an open high-low close product on? And the reason I'm picking this is because it takes the analysis to its extreme. Okay, we're trading butter. We want to trade the volatility of butter, and it's open for 5 minutes on Friday. Okay, there's an open, a high, a low, and a close that are almost the same. I mean, the volatility of butter for 5 minutes is going to be practically zero, right? What's that going to do to the formula? Well, take that and contrast that with a market that's 24 hours, like currency, okay? Your high and low and close are all going to be, very different from a market that's open 5 minutes. And what about the open? If it's really 24-hour market, the open tells you nothing because it's the same price as yesterday's close, right? It's not like trading cattle or something that's open 5 hours a day and the open tomorrow might be totally different. Now you're talking about an open that gives you no value because it's essentially the close yesterday. It's just 1 tick, 1 second, whatever, after the close of yesterday. So there are all kinds of adjustments that need to take place. The high and the low is going to be affected by how many hours you trade. The open is going to be affected by how many, if you're trading 24 hours, and that open will be less accurate. You could chop up the day into hours, let's say that, and you get more accurate of a value.
Discrete periods throughout the day that you can analyze.
So that's another way of doing it. But all of those, again, you have, maybe 5 hours with cattle, you got 24 hours with currencies, you got 5 minutes with butter kind of thing. So the point is that in all of those scenarios, complexity increases like exponentially. But in all of those scenarios, the close is still the close. It's still the same, and it still gives you the same amount of information. And not only that, the over-the-counter market trades with daily closes. So not only is it simpler, it mimics more of the volatility swap and variance swap market that trades over-the-counter. That's why we do it, and it's really just for simplicity. The VIX is sort of a measure in complexity, if you will. I mean, it's just a very, very complicated formula and process that takes 7 pages of website to kind of go through one calculation. We wanted ours to be completely different, that you could calculate on the back of an envelope. So, we're giving up a little bit as far as accuracy, but we're still giving you a great view of volatility. And what's interesting is that also opens up a very interesting day trade, which I know several times we mentioned on the show before. So, that day trade could actually bring in more volume and liquidity to the product. And in fact, that's more important to bring in volume and liquidity than it is to have the exact right perfect volatility, because it doesn't matter if I can calculate it perfectly, exactly. Here is the volatility.
There's no contract.
The Nirvana version, but nobody wants to trade it because, they can't do it. So then what good is it, right? You got to be able to trade something. And so this was the best compromise between simplicity, liquidity, and giving you volatility.
So, Bob, I think listeners, if you read between the lines here, what you're really saying is that coming soon from Volex is the vol contract for butter. That's what you're saying, correct?
Yeah, that's it. That's our
vol
second.
Butter.
That's right after Nasdaq.
Multi-listed across the exchange universe.
Mark, you really stop talking like that. We can't be talking about new products that are coming out until we actually announce it.
Cut that from the show. I'm getting too far ahead of myself. But all right, Bob, I'm glad we can make it on today. I'm glad we can make this work. At the lovely croquet courts here in Boca. And you're right, it is quite the impressive game going on behind us. I haven't had a chance to watch much of it, but I can see Bob's eyes going back and forth as the match progressed. So definitely scintillating stuff going on here. And before we go, any other parting thoughts you want to leave our listeners with?
One other point is just with the mechanics. So one thing I just thought of is that we're going to calculate, when we say 1 month volatility, it's approximately 1 month. It's from option expiration to option expiration. So that, right now that's the third Friday after the second moon, or however they calculate it now, right?
Same day as butter expiration.
So whatever that expiration is for the options, then that's the day we're going to start. From last month's option to this month's option, and we're going to calculate the exact returns for that period. Sometimes that might be 5 weeks, sometimes that's 4. If there were holidays in there, that might even be like 3.5. As far as trading days, so those number of days are going to vary, and that then means that we can't settle to an index. I haven't figured out how to create a historical volatility index that has a variable number of days in it. So what we do as far as our indice is give you a rough approximation. We're going to calculate the 1 month volatility as 21 days. Why 21? That's 1/12 to 252. 252 is our annualization factor. 1/12 of that is 21. So we're going to calculate the 21-day rolling volatility just to give you a handle on what this animal looks like. We're going to call that real vol. We actually just changed the name. We've had several meetings this past week. Instead of H-vol or historical vol, we're going to call that real vol and try to market it as such.
Far sexier, if I do say so myself.
Thank you. And there are all kinds of implications there, but I won't get into that right now. But the point is, we have an index, but it's just for reference, and it's just to give you an idea of what the animal looks like. We're not going to settle to that. We're going to settle to the actual returns from option expiration to option expiration. And then this also brings up the 3-month version. We could calculate 3 months worth of volatility every month and say, here's the 3-month for January, here's the 3-month for February. We're not going to do it that way. We're going to do monthly, January, February, March, April, and then the 3 months will be quarterly. So March, June, Septis, like that. So that should give everybody a little comfort and and a little bit of clarity as to exactly when we're going to trade, what exactly the period is and when we're going to expire and how it all works.
Well, there's our basic framework for you listeners. We actually did it a little bit backwards. You listened to this show first, then the show, our mailbag extravaganza, I believe it was, where Don and I went into some strategies. So then if you do these out of order, you'll have a good sense of exactly what you should be doing with these products. But Bob, thank you very much again for joining me here. And we should record here every week. This is not a bad location, particularly in the heart of winter. Maybe back in January and February would have been even better. But this is a great place to do our once a year live from Boca episode. Looking forward to next year's already. But thank you for joining me, Bob. And of course, we want to thank all of you out there for downloading, streaming, and subscribing to the program and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.